In audit procedures, there are few terms that we should know. First is inspection. It is a process where the audit staff investigate clients' records or documents. Inquiry and information is to seek knowledge and confirmation from company internally or externally. Next is recalculation and reperformance to check and perform calculation. Observation is to observe client staff performing a process that is related to the area of audit concern. Last is analytical procedures, which identifies and investigate unusual fluctuation and items, especially in bank statement. 3 classifications of tests of controls are reperformance, where auditors decide to make a new transaction in order to test which controls are being used by client and its effectiveness. Whereby observation is when auditors observe a business process going on, and specifically the control elements of the process. Lastly, inspection. Auditors may check business documents for approval signature, stamps, or review check marks, which detect that controls have been performed. Substantive procedure is a process, test or step done by the auditor to detect any material misstatements or financial fraud. There are 5 assertions needed under this procedure, which are completeness, existence, rights, and obligation, valuation and presentation, and disclosure. Let's discuss the first type of substantive procedure, which is analytical procedure. It is a comparisons of information from various sources to identify whether reported data looks odd. A further review need to be done on data with unexpected differences. Analytical procedure can be done at the beginning of audit process in order to better understand the company and obtain information needed to plan audit procedures. Middle of audit process to gain evidences regarding account balances and classes of transactions, or end of audit process to make an overall review of financial statement tested. The next type of procedure is tests of details of transactions. It is a transaction test for errors and fraud of specified transaction. It is done by confirming the transaction amount and tracing it back to the transaction accounts in the FS. The last type of procedure is test of details of account balances and disclosure. This deals with the confirmation of the ending balances of individual accounts in the statement of financial position.
Audit evidence. What is audit evidence? Audit evidence is referring to information that is collected by an auditor for review of the company's financial transaction, internal control practices, and any other matter which are needed to certify a client's financial statement. Why audit evidence is important? It is because to support opinions stated in the audit report and determine whether statements are fairly presented. Next, we move on to the criteria of good audit evidence. A good audit evidence must have these 2 criteria, which is sufficiency and appropriateness. Sufficiency is the measure of quantity of audit evidence. The quantity of audit evidence can be affected by risk of misstatement and risk associated with internal controls. If the risk increases, the amount of evidence that obtained by the auditor will increase. Appropriateness is the measure of quality of audit evidence. It can be determined by the relevance and reliability of audit evidence. Relevance of evidence must be relevant to the audit objective. Reliability of evidence means that evidence can be believable. Reliability of evidence depends on the 6 characteristics, which are independence of provider, effectiveness of clients' internal control, auditor's direct knowledge, qualification of individuals providing the information, degree of objectivity, and timeliness. There are 2 determinants of persuasiveness of audit evidence, which are sufficiency and appropriateness. Both persuasiveness and cost must be considered in making decisions about evidence for a given audit. Goal of an auditor is to obtain an enough quantity of appropriate evidence at lowest total cost.
The final part of our discussion for this week is on the types of audit evidence. Types of audit evidences consist of physical examination, observation, documentation, confirmation, inquiries of client, analytical procedures, and reperformance. In physical examination, it usually involves an inspection done by the auditor that involves counting of tangible asset, such as cash and inventory. For example, to check whether the information regarding the amount of cash in bank is correct or not, the auditor can check with a particular bank. Observation is an activity that involves observing clients' activities. For example, visiting a client's facilities. Documentation is an inspection that involves auditors to inspect clients' documents and records, which consists of internal documents and external documents. Internal documents is prepared or used within the client's organization. Meanwhile, external documents is handled by someone outside the client's organization. Confirmation is a direct written response from the third party verifying the accuracy of information required by the auditor. The client will request the third party to respond directly to the auditors. Inquiries of client is an activity of obtaining written or oral information from the client by questioning them. The disadvantage of this type of audit evidence is it is not conclusive as the information is not independent. Analytical procedures involves understanding the client industry and business, evaluating whether the entity is able to continue as a going concern or not, and stating whether there is the presence of possible misstatements or not. And lastly, re-performance involves auditors' independent test of client accounting procedures or controls that were originally done.